Let's look a little deeper into why existing management strategies fail. And we know they fail because we'll see that legislation has come around in order to deal with that failure. So I think the most visible failure, but certainly not the only failure, was the failure of Enron in the 1990s. But there were definitely many other failures in the 1990s, such as WorldCom, Imclone, Bernie Madoff, Briex here in Canada, Tyco. All of these different companies were all dramatic failures, damaging the share value of tens of thousands, maybe millions of people, bankrupting people. Bernie Madoff, he destroyed the retirement of thousands of people that were forced to go back to work because he ripped them off. Now, all of these frauds and all of these scandals, they weren't marketing scandals, they weren't production scandals. The essence of it was they were all accounting scandals. And what happened was that through the failure purposely to observe the proper accounting standards and reporting, all of these scandals were able to be perpetrated and damage caused to all of these people. Now, the truth is that you don't get rid of scandals by passing laws. We certainly do need to have laws to deal with the fact of these scandals. But the essence of how we get past these scandals is to return ourselves to a base of ethical management. You can be as competitive as you want in the marketplace, but you can't create products that are toxic to people and not tell them. You can't report your earnings 3 times higher than they were. You can't hide expenses to make your profitability look that much greater, because you're damaging, in today's marketplace, you're damaging millions of people who ever own the shares of the company that you're doing this in. And I would say that before we talk a little bit about how these scandals work, clearly what we pay managers to manage has got to change in terms of the goals we set for them. Because when you tell a manager, if you increase the share value, we'll give you a bonus, but if the happiness index of the employees shifts up or down, we really don't care, then you know that the happiness index of the employees is irrelevant to the management decisions of that manager, because he's looking for that bonus that you promised him. So we have to have a consistency. It's not just enough to say, we want you to be morally responsible, but you've got to, this has to be demonstrated in the way people get paid. So that is one underlying concept that you have to keep in mind. The second thing that you need to know, and this is a constantly fluid issue, and that is the law. Prior to the Enron scandal, people could hide behind the corporate veil, the corporate liability and legality, in terms of the actions that they took. So if someone polluted a neighborhood, such as the story with Love Canal, then they were able to be excused individually, and the company got blamed, and the company paid the bill. So you could have made a horrific decision 40 years ago You will never be called to task for that decision, which gave you bonuses. But now, once the company is sued for all the damage that was done, the shareholders that are now in the company are paying the price for those decisions. So, in order to deal with that kind of an issue, the government realized, because that's what happened at Enron, by the way. What happened at Enron, just to explain it to you before I go on, is that Enron grouped together companies that were small, risky, and in the resource field. So you could have been diamond mine, you could have been oil and gas. Everything was brought together in Enron, which was a giant trading hub, and they acquired these companies, and then they sold the shares in Enron, which was then holding all these companies. Now, accepted accounting procedures clearly says that you record revenue in the year that it's earned. So if I have a gold mine and I've determined that this gold mine over the next 10 years can produce $100 million worth of gold, at about $10 million worth of gold a year, every year I would record exactly the amount of gold that I got out of the mine. Could have been 10 million, 8 million, 12 million. That's what the law says. And then, of course, as you know, the revenue minus the expenses is what gives you the profitability. And the profitability is what plays into the value of your shares. Now, if I make an argument to you that says, that's not really fair. I've acquired this asset. It's my asset. I own it. This gold mine is mine. Or, sorry, it's not mine, but it's owned by the company. So what does it make a difference if I record the revenue now or over the next 10 years? The only person or people or entity that's going to get the revenue is this company. It's not like being a sales company where if you don't make the product, you can't sell the product. There I can understand the reason for recording sales when you get them. But we have it all. It's just a question of getting it out of the hole. We already know that it's there. So therefore, I believe that we should record the value of the mine, not just the revenue. That's what Enron did. Jeff Skilling and Arthur Anderson, their accountants, all colluded together to violate American and Canadian law and report earnings far in excess of the truth. Now, the shareholders had no idea what was going on. So as far as they're concerned, everything's being done by the book. Now, you can understand what's going to happen. The moment that they stop acquiring new resources, new companies, that flow is going to end. And now we're simply going to be waiting for what's coming out of the ground. And what's coming out of the ground has already been reported. So in essence, they're demanding that the company constantly, in order to grow, must acquire more and more and more natural resource companies. But there is a finite limit to the natural resources on this planet. So even if they acquired every single company at some point, they can't acquire any more. And at that point, the whole company implodes because there's no longer any revenue if you agree with their contention that we report the revenue in the year we acquire the asset. Of course, that's not the law, but let's just assume for a moment that that's what you did. If you then decided to record the revenue of the asset twice, then of course you'd be double counting. So you can see it's a pretty sticky situation. And that's what Enron did. That's why they collapsed. That's why all the money that people thought was there was wiped out, and retirement plans, investments, and a whole host of other savings were destroyed, including the pensions of most of the people who work there. That's why the U.S. government passed the Sarbanes-Oxley Act in 2002, and Canada passed Bill C-198 in 2003. Both of the legislations began to make individual people responsible for the corrupt behaviors that were demonstrated in Enron and Tyco and Bre-X and all of these other scams. Now, the first group of people who were made responsible were the directors of the company. They were told, if this happens in your company, we're not going after the company, we're going after you personally. Now that made a humongous difference, because now suddenly the directors understand that any of these games that companies are playing, the end result out of pocket is going to be for them. And I can tell you that personally, I've been involved with one organization, 5 accountants on the board of directors. They were caught in a scheme that was perpetrated by their bookkeeper, and each one of them had to come up with about $50,000, if I remember correctly, to pay off the government. Sorry, $30,000 to pay off the government. So these new laws have very strong teeth, and they are designed to make the board of directors personally liable for these choices. That means they can come and take your house, your car, your cottage, and anything else you own. Now, since that time, I mean, there's a lot of details in these laws, but generally speaking, since 2002 and 2003, there have been amendments to these laws, widening the scope of inclusion, so that essentially, at this point now, it's not only the board of directors, but the accountants, the executive group, and to some extent the middle management group, depending on the responsibilities that they have. So the moment that the accountants became liable, now we're doing the year end for a company. Instead of being asked 4 questions, I'm getting 4 pages of questions. So it really changed the way things are done. However, this is designed to protect the shareholders by making those people who make the decisions take responsibility for their decisions. Just as I'm telling you as a manager, if you want to be an ethical manager, you have to take responsibility. The government at this point is mandating that for the key operating officers of a company on a personal level, and you can't escape it just by leaving the company. So just to summarize then for regarding Enron and what went wrong, we can see that a company that is strictly focused on profitability, managed by gladiators, will inevitably resort to unethical behavior because the gladiators want to win at all costs. And so where many of you might have thought that, gee, I think I'd like to have a gladiator running my business if I was a shareholder. The reality is that the shareholders are frightened as heck that they inadvertently hire someone who behaves that way. Because they understand that a gladiator ultimately does what is not in the company's best interest, like the movie Wall Street portrays with Gordon Gekko. But ultimately, the gladiator does what is in his or her best interest. And what we're trying to do by teaching corporate social responsibility is, rather than narrowing the net so it serves just the gladiator, we're trying to widen the net so that it serves the entire constituency of the company.